Okay, welcome everybody to episode 87 of the Volatility Barometer podcast. Now, it's been a while since I've done one of these. I'm going to see if I remember how to do it. And right off the bat, it says that one of my destinations is not working. So I don't know if that means you people on Facebook or on Twitter. One of the places that I'm streaming to is not going. I'm sorry about that. Technical difficulties is kind of what we do here. So we are just going to push through. But it has actually been quite a while. So thanks everybody for showing up. I see there's some questions coming in. All good. We will, of course, do the live Q&A later. But I have actually been on a 5-week European holiday. So for anybody who didn't know, that's kind of where we were at. We started in Amsterdam, hit that for a while, and then we went on a 3-week cruise to Norway, which was awesome. We hit Scotland for several days. We came back and went to Belgium for several days, and then Paris for a week. It was kind of a, Northern European vacation. It was awesome, but I know it was a little bit long. And one of the things about the YouTube algorithm, and I'll just ask everybody for a little quick favor here. One of the things about the algorithm is that it's actually better to not do any content at all rather than do sporadic content that people don't necessarily like. And I did take my YouTube studio with me, but the internet was sparse and the hotel rooms were small, and we actually had to pack for many different types of weather conditions. I mean, we were, in Paris, it was nice. In Belgium, it was hot, but, up above the Arctic Circle, it was pretty rough. So, the hotel rooms, there's stuff strewn everywhere. It was not ideal. So I just chose not to do any content at all. But that's where you all come in. If you could do me a solid, it would really help the YouTube algorithm if you could not only give this video a like for me, but just over the next couple of weeks, because right now, after taking 5 weeks off, I will be in YouTube purgatory, so to speak. So to kind of resurrect the channel, make sure that the next few videos, you give them a like for me, and also leave a comment. Watch the video. If something stands out, leave a comment. I do answer all questions. So if you've got something specific, or if you've got a recommendation for a follow-up video, I do all of that. So make sure that you just kind of help the channel get back to where it was before. We actually had a pretty good stride going there for a while, and I'm going to highlight some of those videos in a few minutes. But it's going to be pretty rough. I don't know how many people are going to be tuning in today, for example. Probably not many because I've been gone a while. But yes, that would be fantastic. So some people showing up. I think people probably kind of forgot that I was doing this, but here we go. So today, what I really wanted to talk about is a couple of things. I will get to the spreadsheet. The download has been updated for everybody. And also, we will get to the first segment, which will have to do with performance. I think you'll probably notice some technical stuff today. I think I just had the sound on the wrong channel there. So I think you heard me, but it was probably a little bit rough on the audio. So hopefully we are all good at this point. I'm not even going to risk opening the YouTube and having a look. So let's just assume that we're all going here. Now, I want to highlight the fact that I have had performance up on the website for 15 years now. This is not new to me. Every month it's updated. And VTS launched in 2012, but I actually was doing that for about 3 years before. So it's been 15 years. This is nothing new. But I don't actually highlight performance that often because I don't feel like it's very beneficial for certainly subscribers of VTS, but just investors in general to be so hyper-focused on short-term performance. You shouldn't be looking at performance monthly, for example. So what I try to do is, if there's something interesting to say, then every 6 months, a year, I'll actually highlight a couple of trends, because longer term you can see those developing, and certainly strategies have to be subbed out sometimes. Sometimes things just stop working. The market changes, doesn't work. So longer term trends is what we're really focused on. And so today we're going to do something. I've just been noticing a few questions, an uptick in certain types of questions regarding our strategies. So we're going to talk about that. But just on a little side tangent, I do also want to remind everybody that while it's not good to focus on short-term performance, because that can cause people to do what I do, is called chasing shiny objects, where you might be doing something for a couple of months, you look over there, somebody on Twitter is making some noise, you think, oh, that's really working really well, I'm going to put all my stuff over there, and then it hits a little bit of a lull and you see, well, that one seems to be doing great for the last couple of months. Let's move to that one. And essentially you're just buying high, selling low, moving around to everything that's actually you're chasing momentum, and it fizzles out pretty quickly. So don't do that. But performance itself is also a requirement. You can't really invest if you don't see that. And unfortunately, and this is one of my biggest complaints about the financial industry, is that you really can't see performance hardly anywhere. I mean, on the ETF level, sure, but there's quite literally millions of asset managers, investment advisors, that the only way you're ever going to know how they're actually performing is to give them some money to invest and basically watch it for 5 years and make your decision. Problem there, it's not too hard to figure out. As we know, study after study shows that, let's say, roughly 90% of asset managers underperform the market. Well, if that's the case, time is your most precious asset, and you don't have 5 years to be shopping around every time, and then you realize, oh, this is bad. Statistically speaking, you're going to have to try 10 of them to find one that is going to beat the market. You don't have 50 years to give everybody 5 years to finally find the person that's going to help you. So performance is a mandatory requirement. And it is unfortunate that, all you can really go off is Twitter. They sound incredible on Twitter, and if you really do a little digging, you'll realize, wow, their performance is actually quite abysmal. So performance is super important, but again, we don't have to do this like in your face every month like the Twitter crowd does. I do it, when I see trends. And so we're going to start talking about some of those trends. But let's pull up a performance little presentation here. Again, largely sometimes this is just for me to keep my own thoughts going. But the number one thing that people have to remember about my work specifically, and I wish I added a little text here that says buy and hold sucks, because we are not buy and hold investors. So I'm sure you've seen something like this in the past where, let's say every one of these represents something: stocks, bonds, gold, real estate, emerging markets, commodities. You've seen those pie charts, right? And they just pile up a bunch of assets and they just basically buy and hold and do a few rebalancing here and there. We don't do that. At VTS, we actually have multiple different strategies, and each strategy itself has both an aggressive aspect to it, where it's meant to be doing the heavy lifting and getting the performance, and then they also cycle into safety, and some of them can even capitalize on a market crash. So I'm not going to go through all 5. Many of you have seen this already. I'll just talk about one just to give you an idea. So tactical investing, in my mind, you've got short volatility over here. This would be for when volatility is relatively stable, and we're going to be capitalizing on the old, in quotes, short vol trade. But there are also times when it's very ambiguous. We don't really know what asset to hold. So at that point, we're going to be parking money in gold. It actually performs quite well during mid to high volatility. And then, of course, during those extreme market crashes, we can go full on long volatility and hopefully be making money during the next recession. So this is what tactical investing is, and all of our strategies largely follow that pattern, where there's different segments. You can almost consider them little portfolios in themselves. And then when you combine it as a total, that's, of course, what we call the total portfolio solution. So that's where the name comes from, of course. And performance-wise, long-term, again, we have short-term periods of bad performance. I don't shy away from those. If you go back to 2022, I talked pretty much the entire year about how uncomfortable it was to be having our first losing year. But overall, big picture, things are going pretty well. So now we will just update where we're at this year. It's been, I'd say, good. Not, blowing the doors off, but pretty good. And this is through Q2 2024. So actually through the first, say, 12 days of July, I think the portfolio's up about 3%, maybe a little bit more than that. So we're talking about, I don't know, maybe 17%, call it, through the first 6 months and a bit. Now, as far as what I was talking about with trends, one of the things that sometimes I feel like people don't fully understand about my work is that and this always sounds bad when you say it, but not all strategies are designed to be high rate of return style strategies, right? Of course, if you've been trading 5 strategies for this long, right, well over a decade, you're going to have some that rise to the top performance-wise and some that end up at the bottom. Statistically, that would be true about anything in life. You line it up, there's going to be one here and one here. And of course, a lot of people tell me, well, why don't you just put all your money in that one, right? That one's clearly the best one. We've seen 12 years of numbers. That's the best one. Let's just put 100% there. And so I wanted to sort of highlight the differences between the strategies, and then a better way of looking at portfolio management as a whole. So getting to the first bit, I thought it would be interesting to show you our best strategy in the last few years, and then show you our worst strategy in the last few years. Again, I'm not going to do all 5 today, but you'll get an idea of what their purpose is, and I can also explain why they're doing what they're doing. So defensive rotation is actually the best one of the last 4 years. That's quite clear. It did have a large drawdown in 2022, but we are using leveraged NASDAQ, so that is somewhat to be expected. But 2024, it's already up 40. I think it's up, 7 or 8% in the last 12 days. So call it almost 50% through right now, up to date today. That's actually very good. And long term, if you want to see what that looks like on a chart, again, we did have a drawdown, a negative year, but overall, pretty solid. This is, numbers-wise, just a little bit ahead of tactical volatility. I think our short vol strategy is at about 31, 32. So this is our best strategy. Now, why would this one be doing well in the last 2 years? This is a trend that I wanted to highlight, and we will go to Yahoo Finance. We can see this. You can see it on anything, really, but I wanted to kind of highlight the fact that it really is tech that's doing well. And I don't think people should be overly surprised that for us, it is our tech-focused strategy that's doing the best recently. Because if you look, let's say you go into the holdings of the S&P 500. Top 5 holdings make up a pretty significant portion of the S&P 500, talking about, almost 25%. If you go into each one of these, and bear with me for a second here, I'm going somewhere. But if you go into all the top 5 holdings, remember the S&P 500 is up, last I checked, about 15% this year. I think through a few days in July, it's probably up a couple percent, so say 15 plus. But if you look at these top performers year to date for Microsoft, we're at 21%, so it's better than the market. NVIDIA, of course, a monster, up 163. We've got Apple year to date up 20, so comfortably beating the underlying. Amazon, 28%. And then we've got Meta, I think it's up, 43%, give or take. So on average, you've got the top 5 companies, these large super cap companies, they're averaging about 55% across all 5 of them. But the underlying is, 16, 17, something like that. It's actually been a year where if you were to remove those 5 companies, the market as a whole, it's really not doing much of anything, right? It is those massive tech companies that's doing something, and that's not new. It's actually been going on for quite a while. So that's why I say, where's my page? Is it overly surprising that this strategy, while having, what am I doing? I'm clicking the wrong ones. While having a negative year there, it's basically bookended by some pretty monster performance. That is not to be expected because we're also crushing the underlying NASDAQ as well. But we cycle out into utilities and cash, and we've actually had a tremendous rate of return. So this isn't overly surprising. But why wouldn't we put all our money in that? Well, it's because over time, of course, diversification matters. So I will highlight our worst strategy in the last couple of years. And this is one of our diversifying strategies. And you'll see a pretty big difference here. This is our iron condor strategy. So we're selling iron condors, essentially. There is room to buy calendars in very low volatility, but largely this is a short iron condor strategy. You can see in the last couple of years, not a disaster or anything, but the first negative years, down about 2% each year, year to date down about 1.68. Why would this be, right? And if anybody wants to see it on a long-term chart, of course it is just a little blip. This is actually quite a good strategy overall. I like iron condors a lot. I've been trading them for, 16, 17 years at this point. But performance-wise, nothing is wrong. But if you look, this is our worst performing strategy. Now, this is where all the questions are coming in. A lot of people are saying, well, why don't you just skip that entirely? Clearly, it's not doing well. Well, you have to understand why it's not doing well. And I actually want to highlight our course material because there is a course. Let me just ditch all these. We don't need those anymore. There is a course about iron condors, and one of the lessons within this course, these are all videos. There's about 30 of them, I believe. All subscribers get immediate access to this. There's a bunch of videos here. It's basically a full iron condor course. But number 14 here, iron condors perform best in higher volatility. why are iron condors not doing well the last 2 years? And this is why I'm not going to remove it from the portfolio, because it is somewhat market specific. But an iron condor performs best when volatility is high. And a lot of people don't understand that point. They think that an iron condor profits when the market doesn't move, right? You set up the iron condor. I want the market to not move at all. I want it to be low volatility, right? But that's not actually the case. Because when you think about the iron condor, if you open one during low volatility, those wings are going to be very narrow. And there's a very small margin for error for those trades. The worst environment for an iron condor strategy is if you're opening them during mid to low volatility and the market is slowly bleeding upwards. That combination of those two things is the worst environment. Low volatility on the entry and then a market that's creeping up. The low volatility on entry, the reason that's bad is because the wings are narrow, right? If you open it during a very high volatility environment, you can get wings that are 20% wide on each side. You know, if you open it during a crisis, very unlikely that trade's going to lose money. So I basically layer iron condors during market crashes and it does very well. I can actually see that on the results if you wanted to look at them. It's kind of a side tangent, but look at the years here. This is the iron condor strategy. 2015 was a rough year for the stock market, right? We had the China hard landing scare. Wasn't a good year. Iron condor is up almost 20%. 2018 Volpocalypse and the Q4 2018 crash of 20% in the market. Our strategy was up. 2020 pandemic. Now, the second half of the year, we gave some of that back because the market was screaming higher. But again, positive year and a bad year for the market. 2022 was a horrible year for the stock market. We were up 26%. Now, in 2 good years, it's down money. And this is kind of what I'm getting at, is that the first reason is volatility is just low. The wings are going to be narrow. The margin for error is going to be small. But why is a market moving upward worse than a market that's moving downward? I know some of you know the answer to this, but it has to do with the follow-up trades. So all trades can lose money. You open an iron condor, you might win, you might lose, right? One trade makes no difference in the grand scheme of things. But if you have a trade that stops out because the market is going upwards, that's bad, because what is your next trade going to be? Well, it's going to be a trade that's opened in even lower volatility than the previous one that just stopped out. So you're actually opening an even weaker trade after a losing trade, and that one is even more likely to lose money. If it goes down, on the other hand, yes, you can get stopped out if the market crashes, but that's just one losing trade. And then the next trade you take, you're going to follow-up trade with higher vega, higher volatility, larger, wider wings, larger margin for error, and you can much more quickly make up for the losing trades. So in my opinion, high volatility is the best, but we can't always control that. But a high volatility crashing market is not actually a problem. That's what people fear the most when they're trading iron condors, because they're looking at something that has a range and they don't want it to exit that range. I look at it as, well, the next 2 or 3 trades after that crash are probably going to be pretty easy and we can recover quite quickly. That's why bad years in the stock market are good years for that strategy. So in a nutshell, this is answering several private emails that I've been getting, but that is essentially what's happening, is that right now we are in a mid to low volatility market and the market is going up. This is not good for the trade you currently have on, and it's not good for the trade that you are going to follow up with after a stop loss. So that's essentially what's happening. Now, obviously, the market is not just going to go up forever, so we're not going to remove this strategy from the portfolio. And if you look at it, 33.93% rate of return compared to 16.51. Best strategy versus worst strategy. Should you just remove the worst one? This gets into point number 3 that I wanted to make, that people are probably, and this is of course my fault because I didn't explain it clearly, but people are probably looking at my portfolio a little bit differently. You know that everybody, the vast majority of investors, have something similar to a 60-40, stocks, bonds. Now, they might have 8 asset classes in that portfolio, but performance-wise, it tracks a 60-40. I actually have a video coming out soon that shows that it doesn't matter if you have 6 major assets or 5 or 3 or just the 2, performance is kind of all the same. Most investors are 60-40 investors. We are not exactly 60-40. Our ratios don't actually align like that. But I think the best way for people to fully understand what we're doing at VTS is to look at our portfolio somewhat similar to that 60-40 ratio, where The majority of your portfolio is meant to capitalize on the very good periods. And no doubt the numbers are going to be quite good during stable markets, right? Defensive rotation is having no trouble at all putting together really good numbers the last 4 years. But there are times when that won't work. So I prefer people look at my portfolio as the primary 3 strategies. Those are the ones that are going to get you the sexy return when everything's cooperating. Now, remember, they do have defensive aspects as well. I'm not saying they're going to crash with the market. They won't. But this could largely be compared to the S&P 500 as a benchmark. I don't know if you caught that earlier, but I always compare my performance to a 60-40. My entire portfolio compared to a 60-40. But actually, if you could just break them down, these are our 3 very aggressive strategies. You can very easily compare these against the S&P 500. That's a fair comparison because stocks are aggressive. I mean, who does a 100% stock portfolio? I have no idea. Crashed 56% just 12 years ago, and it will again, I'm sure. But it's pretty fair comparison to do that. You are separating. See the correlation at 62% to the S&P 500. That's not high, that's about mid correlation, but it's definitely positively correlated to the stock market. So totally fair to compare it to the stock market. And again, you've got a pretty large performance here. We're at 32 compared to 14 for the stock market, similar drawdowns. I like to use the average of the 3 for long term, pretty similar drawdowns. Ours is slightly lower, but let's call it a wash. But the other aspect of our portfolio, this would not be fair to compare this against the S&P 500, would it? This is entirely different. And the reason for that is these 2 strategies, if you do 50% vol trend and 50% condors, we have a negative correlation to the stock market and extremely low drawdowns. These strategies are not meant to blow the doors off of anything. And I think that's what a few people are misunderstanding. You don't just remove the strategies they're there entirely to diversify a portfolio. This is never going to make 33% like defensive rotation is. It's not meant to. Look at the average of the 3 largest drawdowns at 7.8%. These are our diversifiers. They have negative stock market correlation. So if you wanted to look at performance with this portion of the portfolio, I say it's much more accurate to look at bonds and gold because those are really the only 2 asset classes that are either 0 or negatively correlated to the stock market, down at 12%. I think this is a fair comparison. And then performance-wise, again, you get that outperformance. But I think the confusion is, and it's very tempting when we're having a year with defensive rotation and of course short balls doing well and anything in the stock market's doing well, it's very tempting to just say, let's just go with this. And obviously it's your money. You can follow the portfolio. This is the total results. This is at 22.74%. This one's at 32. Maybe you feel it's worth it to chase that extra 10%, knowing that your drawdowns are also going to be a little bit higher. Maybe that's worth it for you. But what I want to do and what my job I feel is to fully inform people of what's going on. And then, of course, it's your money. Of course, you can do what you want. If you did want to just remove the diversifying strategies that we have, well, I can't stop you, right? I don't do that personally. What I present in the emails to everybody every day, all of those trades since we launched in 2012, that's what my money is in. Now, of course, I have a portfolio of option trading as well. I don't show those in the email. It would just be a nightmare. But the VTS strategies, this is what I do. And I do trade the iron condors and the vol trend in those allocations you see in the email. Can't force people to do it, but at the very least, I can inform you that there is some, method to the madness, so to speak. I actually do know what I'm doing, and I do know why those strategies are there. Even though on an absolute basis, is it really that difficult to see that long-term this is better than this? It's not really hard to see, right? 16.51 compared to 34. Well, who can't do that basic math? The problem is on a risk-adjusted basis, they're actually very similar, right? Again, teaser, another video coming soon talking about the difference here. You might think 34% return, but a 40% drawdown compared to a 16.5% return and a 15% drawdown. If you look at it, I have my own self-designed performance score. This is how I measure all results. And 1.26 compared to iron condors at 1.12, they're actually very similar. Even though the return is half, the drawdowns are half as well, less than half. So that's the reason that we have this full diversified portfolio with 5 strategies. It's very obvious that a couple of them are doing better than the other ones, but that's the same thing with bonds. It's obvious that bonds are worse than stocks. It's clear as day that gold is worse than stocks. Well, it's obvious that every asset class is worse than stocks. Why do people still hold the diversified portfolio? Well, it's because most people underestimate their own risk tolerance, and you can't hold the aggressive portfolio through the crisis. And if you can't sustain the crisis, you won't be there to invest when it recovers. Because even our strategies, as I showed in 2022, down, right? Not fun. People pulled the plug. People left. And then they didn't participate in the 87% that we made last year and the 50% that were up this year. You miss that. If you pull out near the bottom, you will miss that. And so my job as an asset manager is to make sure that myself, of course, because this is self-serving, it is my own capital, but also anybody who chooses to follow my portfolio, you have to also know that I'm trying to make sure that this is a portfolio that you're not going to pull the plug on when things go badly, because they are going to go badly. Nobody bats 1,000, right? You're going to have periods where the market just gives you something that you can't handle, that your strategies will not perform well. That's going to happen. It's happened before. 2022 was my first losing year. It's going to happen again. I'm trying to make sure that you don't pull the plug and then miss out on what I suspect will be an eventual recovery. So that's the whole sort of the rhyme and reason behind what I do. And with that in place, now that you know, you've been fully informed, of course, you can invest in any of our strategies, any combination of them. You can do the full aggressive if you want. Maybe you are a 60-40 investor. Like, that's another thing. Maybe you put half your money in a 60-40 and you put the other half in 2 or 3 of the best VTS strategies. Maybe that's going to be what you do. And you do skip the diversifiers. Maybe you put half your money, I would say, I can't give you any direct investment advice, but don't do this. But let's say you put half your money in bonds. I personally think that the bond bull market is dead, both mathematically and also just the macroeconomic level. It's probably not going to work out much more than inflation at this point. But let's say you put half your money in bonds and you put the other half in our aggressive strategies. You can do that. I just want you to know that this portfolio and this portfolio, while they are part of the same thing, they are radically different and they have totally different purpose for them. So as long as you know that, it looks all colorful and pretty here, but these are not all created equal, so to speak. Just be aware of that and then allocate accordingly. Do whatever you want now, being a fully informed investor. So that's our spiel about performance. Things are going well. We are way above all-time highs. So hopefully, knock wood, we can say goodbye to that losing year we had and we've righted the ship, so to speak. All right, so another thing that I want to draw attention to really quickly, and I do want you to watch this video, so where is my YouTube channel? You can see the very last video I did. Well, of course you can't see that because you're staring at me. Come on, where's screen share? Screen share, here we go. Go to the YouTube channel. The last video that I put out before I went on my extended Europe vacation was about the spreadsheet. And I said in this video that it's a free download. It's got all the volatility data. I'm going to look at it in a second. But I will be updating this every quarter. So at the end of March, June, September, December. Well, it is the end of June. So as of now, it has been updated. So that spreadsheet, just to go through it really quick, that video is much more extensive. But of course, it's got all the volatility data going back, all the VIX futures going back to 2004. So we'll get back to there. It's also got the days to expiration, the futures roll. So you can calculate things like adjusted contango, and you can see the VX30 to VIX roll yield. Remember, the absolute raw values don't mean anything. You actually have to adjust everything based on the days to expiration. Then we've got the cash VIX term structure. If we go down, some of these aren't available, but we've got the 9-day, 30-day, 3-month, 6-month, 1 year, all that stuff. All the underlying indexes for all of the volatility products. So these are somewhat important if you're a vol trader. And then, of course, the ETF numbers as well. So Pick your favorite one. Some people like VXX, UVXY. We've got the inverse ones, SVXY and SVIX, all of that stuff, plus the old terminated ones. I just threw them in there for fun, basically. And then a couple of extra sheets just showing how to use this data. Very basic stuff right now, but we will be adding to this, right? So every quarter this will be updated. It doesn't change much, but of course you can see your percentiles there. VIX index back to 1986. This really doesn't change much because that's a lot of data going back many, many years, but at least you'll have all the VIX values going back as far as it goes, including the good old, October 1987 crash. And then this is something that's important for investors. We've got a benchmark that you can use to measure your performance against going back to 1990. So we've got S&P total return, S&P including all dividends reinvested along the way. We've got the bond market to 1990, gold to 1990, and then a 50, 30, 20 going back to 1990, calculated with the rate of return, the drawdowns, the monthly numbers, if you wanted to compare anything there. It's all here for you. And then crypto data. I've been getting into crypto in the last year or two. As you know, I've made some purchases. I've designed some strategies. I am not a crypto diehard. I do think its days are numbered. I think we probably got about 3, 4, maybe 5 years to go before it really fizzles out. But I'm going to take full advantage of that while it's still here. So we've got crypto, Bitcoin numbers going back to 2012. And I just do want to highlight quickly, because this is way more tedious than people realize, it is trading days only. So I have removed all weekends and all holidays. So you could, if you wanted, just take these numbers and compare them exactly day for day to the stock market. Of course, not for 1990, but starting all the way down here, you get the point. Starting in 2012, these are trading days only. And then over here, I also included the grayscale. When did that launch? 2015, right? Somewhere around there. You've got the grayscale 2015, and you've got the 2 times Bitcoin futures starting slightly before that. You've got that data as well. And then inflation. Of course, inflation adjusts everything you do. Inflation is going to be extremely important going forward because I think it's way higher than the government numbers are telling us. But you've got all the CPI going back to 1913, and you can just inflation adjust everything you do. So that's the spreadsheet. It's updated as of the end of June now. So it is free, basically, free with an asterisk. I'll tell you how to get it. All you have to do, if you want to download that free worksheet, is go to my website, volatilitytradingstrategies.com, click on subscribe, and actually subscribe for the monthly subscription, right? You can click here. Now, of course, monthly subscriptions receive a free 2-week trial. And when you subscribe, you will get an email from me every day highlighting a certain aspect of our portfolio. So you can get a welcome package, and hopefully you stick around a little while and actually give our portfolio a serious look. But we've got, something that goes out to you every day. The spreadsheet is there at lesson 13, but, spoiler alert, if you wanted to, on day 1, right after you subscribe, you could immediately go into your video library, immediately go to lesson 13, and then just go over here on the right and download the spreadsheet. So you didn't hear it from me, but if you wanted, you could subscribe, download your spreadsheet, and then politely exit the subscription. I won't hold it against you. We will still be friends. But hopefully, like I said, you will stick around at least for a week or two and check out the Iron Condor course, check out the Volatility ETF course that we have in there, check out the UVXY Butterfly course. There's a stock replacement course. I think there's a lot of content there that you might think, oh, well, I came for the free spreadsheet, but there's actually some stuff here I want to give a look. So there you go. Pretty easy to get it for free, but it's updated. And of course, going forward now, I can do videos and I can add to the spreadsheet. So again, make sure that you leave a comment telling me what type of data that you would like to see in the future. And if it's not proprietary to what I do at VTS, if it's not going to give any of my own personal secrets away, I'd be happy to add that to your spreadsheet. And then in the next update, we would go ahead and do that. So there you go. Pretty easy stuff. The last thing, YouTube hitting, there you go. Hit the like button for me, everybody. It's really, hitting the like button and making a comment is really the best way that the YouTube algorithm can tell whether people actually enjoy the content. And unfortunately, a lot of my content doesn't get engagement because I don't say controversial things. So making comments is a little bit trickier sometimes, but please do ask questions, say, hey, good video, or, say, hey, I didn't like this part, or, I don't understand that part, or maybe you should do a follow-up video talking about this ETF instead, or, you get the point. Make comments. But the last thing that I want to do really quickly here, because the content, now that I'm back from my vacation, it's going to ramp up here. It's actually going to be a pretty good pace, I suspect. What I want everybody to do is actually get caught up, because there's a 5-week gap here. We had a little bit of momentum here. The last, say, 8 videos, I was getting more emails afterwards saying, hey, that was a good video. Maybe you could do this. I think people are liking the direction we're heading. So there's 3 of these that I want you to check out basically this week and this weekend, so that you can get ready for the 4th video, which should be coming out fairly soon. So the first one is this one called the Volatility ETF.
So you can see there's multiple.
And essentially it is an entire video getting from teasing all the volatility products, talking about all of them and how they develop, getting to the very end, which is the full volatility landscape. You kind of have to know this stuff if you're a vol trader. So go ahead and watch that video. That's part 1 of the course. And this course is going to have about 20 videos, by the way. Part 2 of the same course is
Welcome back.
Sorry about that volume. Explaining the VIX futures term structure. So this thing that everybody has seen, basically explaining how this thing works. This is also extremely important information for anybody who wants to make money trading volatility products, right? You have to know what all of this stuff means. So check out that video. You might have already, but if you don't, you need that as we're building this course through. The third one is specifically, how do volatility ETFs
Like
work?
I said, supply and demand.
I don't know how that's going to play on volume-wise. Sorry if you were wearing headphones and this is somehow louder, but I'm going to play this for 5 seconds.
It means nothing here. The VX
Where am I going to do it? Maybe I'll go from here, just to get the point.
in 5% from front month to back month every day, making sure that it's a constant 1-month VIX future that we are tracking. That's what the underlying index tracks.
So essentially, I think you get the point. For that video specifically, it's how volatility ETFs work. And then from there, hopefully, now we can get into the actual course, which is coming. Where is it? We see we got a lot of courses here. This one here, Volatility ETF Landscape. We have 3 videos posted, but there is actually going to be quite a few. But we can't get into all this cool stuff if you don't know what the ETF is or how they function. So that's why I'm spending the first, say, I don't know, what is that, 7 or 8 videos, just explaining things like the fixed futures, the beta slippage. We got a few more to go, and then we can get into what's the UVXY, what's SVIX, and of course, highlight one. There's many more of these. We'll keep going. But what is SVOL? I know a lot of you, I just don't understand it, but SVOL is a popular product. I don't think it should be. We'll get to that in my video, but yes, that's coming for sure. So all those people emailing me all the time, what do you think of SVOL? What do you think of the big fat dividend it pays? We're going to get to that one, and apologies ahead of time, but I'm probably not going to give it much of a glowing review. But at least you can watch all the videos and understand why, at the end of it, I can arrive at the conclusion that you should just skip SVOL entirely. But give me a few months to get to that, because it's a pretty long course. Watch those videos through the weekend. They're less than 10 minutes. I think they're 5 to 7 minutes, something like that. And prepare for a content stream coming your way, because I am back from my vacation. And if anybody cares, not that you should or would, but if anybody cares, I do have an Instagram account. I will share some pictures and whatnot from our trip, but my Instagram, it's not a business Instagram. It is largely just, me sharing pictures, my cat, pictures of my wife, things that we do, golf, running, stuff like that. So, but if you are interested, I do actually have an Instagram, and I'll post. I'm way behind here. Look at me. I'm sitting here in Dubai. I'm back home already. And this was 5 weeks ago. I could post once every day, because this trip we did something cool every single day. So, Amsterdam. This is Ålesund, Norway. This is, okay, this is like an exam. This is Trondheim, the Nidaros Cathedral, all that stuff. Vanessa bought this cool Viking hat. She got a lot of good attention. People were smiling and giving her the thumbs up every time she saw her. Yeah, pretty fun times. But if you care, just search Volatility Trading Strategies on Instagram and you will find me. So there we go. Let's get into our world famous open live Q&A. See some questions in there already. I don't know how long we're going to go here. My house is brutally hot because the wife hates the air conditioning. And so I'm sitting in Dubai. It's hot. We went golfing yesterday. We actually tried to golf. It was 43 degrees. It's hot in my house right now, so I might have to pull the plug. But here we go. How is your BT Bitcoin system research going? So good question. Thank you. Good. Really good. As you know, or as you probably have heard me say a million times on the live streams, I've always got 10 or 15 strategies going on the back as well with live capital, and I've been doing that for a while. Typically, I would like to see a strategy go from the initial development stage and give it a couple of years of live trading, hopefully through different market environments. If you could get a market crash or two and you could get a nice bull market period, that would be great. Sometimes you can't. I've been trading that strategy with Bitcoin now for about a year and a half, give or take. And there's only really been one significant down period in the market during that. So it's not a fantastic test so far, but it's pretty much ready to introduce. I think it's good. Rate of return is, I've been happy. I've been making a lot of money off it. So don't be surprised if I introduce that pretty soon. It's a little bit different than the other one I talked about. The other one that I shared was basically, I don't know when it was, June 2022, something like that. I bought 2 Bitcoins. I don't even know the dates, but bought 2 Bitcoins, about $24,000, something like that, 24,500. Very close to that, 460, I believe. And I sold one of them at 66,000, and the other one I have still going right now. And for that strategy, I am only pitting a buy and hold 1 Bitcoin. And of course, if you're a big crypto baller, you can go 5 or 10 or whatever you want, but 1 buy and hold Bitcoin versus 1 actively traded Bitcoin. That's the goal of that strategy. And I haven't bought the second follow-up purchase yet. I actually almost pulled the trigger when it hit 55,000, but I didn't yet, so I think it's at 58. But this is an entirely different strategy. This one is, the quant-based, rules-based system. If this, and this, then do that kind of thing with some safety and some exiting to cash. I wouldn't say it's exactly like you've seen, but it's not that dissimilar from our tactical rotation strategies. It's just that the aggressive position will be Bitcoin. And the reason that can work pretty well, at least for now, is because there is actually a fairly high correlation between the NASDAQ and Bitcoin. So it's not a perfect substitution. I've had to really mine my spreadsheets and find the metrics that work the best for Bitcoin, but it's not all that dissimilar from what we've seen. So you'll probably actually recognize quite a bit of it when you see it. But it should be, I don't know, there's no hurry. I don't like to just rush things out. I'm not doing it to get views or clicks or anything. It's been ready for a while, but when I get around to it, I will introduce that for you. So that's where we're at. Welcome back. Thank you. I'm ready to be back, to be honest. An incredible vacation, but I am ready to be back. It's pretty rough. I was seasick. I was, sleep deprived. It wasn't working very much. It was rough. But all right. So thank you for your hard work, passion, commitment. Thank you. That's a really nice comment. I appreciate that. Hopefully over the next couple of months, you will see that ramp up again. Oh, there's a follow-up here. Do you ever take profits and scale out of your positions to lighten up your positions for risk management, especially when a trade gets long in the tooth? How would you know that? Or just stay as is and wait for VTS signals. So I kind of teased at the answer there. Gets long in the tooth compared to what, right? That's always the problem that people have when they're using their gut instincts to make trade decisions. So the short answer is no, I do not do that. If this is just a proxy for our 3 aggressive strategies, all 3 of these kind of work the same. They're just different assets, different volatility metrics, but they're all kind of the same. There's an aggressive, there's a safety, and then there's a full-on extreme. We got to get either out of the market or we have to capitalize on this and make profit because the market's crashing. They're all kind of like this. And the only thing that kicks us out into these positions
are the volatility metrics that I'm tracking. It's not my decision to make. The strategy is mine. I designed it. I put it in motion. But once it's in motion, I don't make those decisions day to day. My spreadsheet does. I enter all of my data. As you saw with the volatility data spreadsheet, I have way more than this. But at the end of inputting all of my data, it just gives me the answer. So I don't say, you know what, I'm supposed to be in SVXY, but I think this rally's about to end. I'm just going to preemptively front run that and jump out into safety. I don't do that. We are in SVXY. We are short vol until the volatility metrics themselves say to not be. And the reason for that is that every trend is a different time frame. You get some trends that are really strong but quite short, and you get other trends that are really weak but they last for 4 months. When do you know to get off the train? You will never know, right? You might, people, you, the proverbial you, not you, but everybody kind of thinks they know how to predict and time the market. And then you do that for several years and you realize, okay, maybe I didn't. You know, it was kind of hit and miss. I was right this time, but I was definitely wrong this time. The example that I can use is, I remember live streaming probably 6 months ago, where I started to talk about how, look, I'm going to stay the course. I'm going to keep these metrics going because that's what I've always done. I'm going to stay in the NASDAQ with leverage. I'm going to stay short vol. I'm going to stay in the stock market. But I feel like the market is just running on fumes, and it's all being propped up by 5 or 6 companies like I showed before. And the macro environment, while the government likes to pretend that everything's good, I mean, election year, they like to lie a lot. So they're talking about employment numbers and inflation's going the right direction. No, it's not. None of that is true. So I was saying 6 months ago, I mean, this feels like if I just kind of ducked out the back door, I bet you I wouldn't give too much back. Well, turns out I was really, really wrong, right? If you look at the results, like I said, defensive rotation, we're coming off a year where it was up 87% last year, and it's already almost 50% this year. If I was the type of trader that trusted my gut instinct and I just said, oh, the market's running on fumes, let's exit, I would have lost over 100% return based in the last year or so. So no, that's a very long way of saying no. The strategies are mine, they're designed, it takes many years of live trading before I even introduce it to a community. But once it's going and it's running and it's successful, I basically just trade it like I'm a robot. I just input all my data, it tells me what to do, it's entirely systematic. I just wake up in the morning, look at the market, oh, look at that, I'm supposed to be in NASDAQ, or, oh, I guess, today's the day, the strategy's telling me we're gonna move into utilities. That's what I do, it's always worked for me. I'm sure that if I started being a more discretionary trader, I'd probably do okay, but I can't say that for sure. I think trying to be as disconnected from the emotions as possible is probably a good idea, and it's never led me astray. So no, I don't make those decisions. Again, I would say the same thing today. My gut is telling me if I exited everything and I moved to cash and came back 6 months from now, I probably wouldn't lose that much, right? I mean, maybe the market goes up, but maybe I avoided a crash. Who knows? I might make that emotional decision, but how do I know this isn't just the start of a raging bull market? I mean, I don't know. So fortunately, I don't have to make those decisions. I just have to make sure year in and year out, as a general audit of what's going on, that everything is still making sense. I don't get into the minutia of day to day, if that makes sense. You've missed me. How was the Europe trip? It was awesome. It was what it was, right? I mean, I'm lucky. Not many people have a job that they can do that for, and then a spouse that can also do that. And then, I got to take my mom as well. So the 3 of us went to 6 countries in 5 weeks, and it was incredible. It was amazing. Last year we did a similar thing, but it was just Switzerland. So we went for a really long trip in Switzerland. We went around the whole country, all on the trains. It was amazing, but totally different vibe of that vacation compared to this one. This one was, for the Amsterdam segment, basically just hop on buses and walking around and taking Ubers and taxis, and then 3-week cruise, 21 days on a boat, and pretty lenient, pretty free hours. Basically, you hit a port and they give you 8 hours to just kind of wander around and do what you want. We didn't participate in too many of the boat excursions. We kind of planned our own. We just went to the city and did what we wanted to do. Amazing. And then we went to, of course, Scotland, which was just the shock that I didn't know Edinburgh was that nice. It was just incredible. And then I didn't know Belgium was that nice. We went to Antwerp, Bruges, a little bit in Brussels accidentally. Paris for a week was awesome. I was warned that it was going to be terrible and crime-ridden and dirty, and it wasn't. Now, maybe that was because it was the Olympics and they cleaned everything up. You remember the whole San Francisco thing where we kind of know San Francisco is an absolute nightmare. But apparently within a couple of days, they were able to clean that up completely because there were some diplomats coming in. So maybe that's what happened in Paris. Maybe because of the Olympics, they just spent a bunch of money and they kind of cleaned it all up. Traffic was a nightmare, but we're not driving, so it didn't really affect us. It was incredible. We got such a varied vacation this time. So awesome. And even the cruise, I didn't think I'd like it, but I actually liked the cruise, aside from the fact that I did win a competition. So my wife and I, before we left, we weighed ourselves, and we were kind of competing to see who gains the most weight, or I guess the winner would be who gained the least amount of weight. And she didn't stand a chance, honestly. As soon as I saw that dessert cart, like there's 20 feet of desserts on that cruise. Once I saw that, I knew she was going to lose, and I crushed her. I gained 3.6 kilograms, not pounds, in a 5-week stretch. So I guess I won. I don't know what I won, heart disease, but I won something. I won that one, and the cruise was great. The only thing I will say, and this is another side tangent, but as somebody who does stay healthy, I've been in the gym my whole life. I run marathons. I've done triathlons. I try to be healthy. I try to eat healthy. So me gaining 3.6 kilograms is like, that's my weight hasn't varied more than 3.6 kilograms in 20 years. I looked like this when I was 20, and now I'm 50 next year, and I basically this is what I look like. But for anybody, just a mild warning. If you ever want to do yourself a favor and take a cruise, once in your life, take a cruise. And the reason you need to take a cruise, and this is going to sound very mean to all those other people, I'm not naming them by name, I'm not doxing them, but take a cruise and just look at what happens if you don't take care of your health in your old age. Because we took a cruise to Norway. We were on, what was it called? Why is that slipping my mind? Holland America. That was the cruise line we took. It has the best scheduling for Norway. They give you about 8 hours at every port, so it was a really good one. But it was, the age groups were up there. I would say the average age was probably 70 years old. My mom's 75. We took her on the whole vacation. She was not old on that cruise. And my mom can move around and she can walk, and we were tracking our steps, and she's over 10,000 steps in many of those days. It was all good. But if you just want to do yourself a favor, just to avoid pain later on, go on a cruise and just notice what happens if you don't take care of your health. That's all I will say. It was heartbreaking to see that there were quite a few people that I would imagine they would have traded better health when they're in their 70s, and they would have given up everything it took to get into that physical condition. I mean, food tastes great, of course, and who doesn't like to sit on the couch instead of go to the gym or go for a run, right? Everybody, it's just better. Nobody likes working out, right? I mean, maybe some psychos out there, but nobody really likes that. But you would trade all of those grueling gym sessions, all of those, or you'd give up all the desserts, you'd give up all the, just to not be immobile at that age. It was hard to watch, but for us, for my family, we had a great time. We had an absolute blast. We didn't go totally insane. The cruise, you could gain 10 pounds in a week on a cruise. It's everything in the world that makes you overweight is right in front of you. So careful if you don't have self-control. But yeah, that's my one recommendation to people is just at some point in your life, just surround yourself with 2,000 70-year-olds and see, who do you want to be? we saw plenty of people that were just, the boat hits the shore and you got 8 hours and boom, there's a couple that's 75 years old. They're out the door and they're off to explore and have an adventure. And we saw 2,000 people that were almost unable to do that. So don't mean to be mean here. I'm not shaming anyone. I'm just saying there is nothing in the world more important than your health. And I've always known that. I've always been an athlete. I've always cared about my health, but no, more now than ever. Believe me, that the day I got back, I was out running. It's just, do yourself that favor. But overall, where's your question? Did I answer your question, or am I just totally ranting? Yes, vacation was amazing. Just home run. Okay. Let's get back into the real stuff. Why was the performance of SVXY so extremely high in the months before its crash in 2018? I could talk about that for hours. I mean, really, I actually did a blog recently talking about that. I think the short time span of volatility ETFs themselves is actually doing a disservice for a lot of investors out there. Because what we saw basically, I mean, VXX launched January 29th, 2009, right? So that is day one of the vol space, so to speak. Obviously, there were VIX futures before that, back to 2004. There's option trading going way back, right? But really, the volatility space for the retail trader became extremely simple then. Now, the volume didn't ramp up until about 2016-ish, but I'm saying that basically we've got 13 years of the volatility ETF space, and we have seen 6 years of incredible performance for the short vol trade, and then 6 years of pretty rough ups and downs where there have been good trends since 2018. Since Volpocalypse, there's been good years, but there's also been some disaster, and it's been much more difficult to make money. But that's probably very par for the course if you were to extend it back long enough. It just so happens that the way we look at the environment now, everybody thinks the golden era was then, 2010, we'll call it, up until 2018, and now it's gone and it's never coming back. Well, that's not true. There have actually been periods in the past, way back before that, where volatility ETFs, if they had existed, would have also crushed it performance-wise. And there's also periods, if they had existed, that it would be terrible. I don't know if you've seen a chart of the VIX index. What spreadsheet do I have pulled up? Wrong one. VIX index, a lot of people don't know this, but during the tail end of the dot-com bust, 96 to 2000, the stock market was raging higher, up 20%, 25, 30%. It was doing great, but the VIX index was in the low to mid 20s. That was what it was averaging. So you got a stock market that's up 30% and the VIX is averaging 24 that year. It would have been exceptionally difficult to trade volatility in a year like that, right? It would have been a total disconnect and it would have been a nightmare. But because volatility products didn't exist, we don't have 6 different periods to gauge. We only have golden era, clear as day, it was crushing it, and now not so much anymore. But the way that I would look at it is this is totally normal. We're going to have periods in the future where you're going to feel like you just missed the boat if you're not investing in vol products. And we're going to have periods where vol products are not actually that impressive. It's just kind of par for the course. So what I would say is, yes, it's true, just mathematically speaking, that things like the old XIV or short VXX, if you wanted to use that as the proxy, it just did phenomenally well for those 6 years, and it hasn't done nearly as well now. But what I would warn people against is thinking that you can extrapolate that to the future. I think that everybody, sort of self-serving here, but who cares? I think everybody needs some allocation to a volatility ETF strategy in their portfolio. Whether it's doing well recently or not is somewhat beside the point. It's going to ebb and flow, and you're not always going to have golden years, and there's going to be some bad years, and there's going to be some losing years. But overall, this is what a diversified portfolio means. Like I said, I could, if I wanted, say, look, I've been trading it for long enough. I'm fairly confident that a NASDAQ-heavy strategy will probably be our best performer. Probably, right? I mean, is that really a stretch to say that? Probably not. But that doesn't mean I'm not going to be trading vol products. That doesn't mean I'm not going to be selling iron condors. All of these things are still going because all markets, all strategies, all advisors ebb and flow in performance. And if you, me, or anybody else out there thinks that they can sort of piecemeal, buffet style, I'll take this at the perfect time and I'll take that because it looks great today, and that is not how investing works. It's pretty dangerous to think that we know that much about the markets. We simply don't. So we're still live, aren't we? I'm getting some error messages. Do you mind if I just take a short detour here and check to see if the YouTube channel is playing? This is probably going to blast something in your ears. If you've got headphones, turn them off. Are we still live? Buffet style, I'll take this at the perfect... Okay, I just said that. So we are still live. I'm getting error messages all over the place, but there we go. You've got some follow-ups. I went on that long rant. I should have read all these first. Is a market which has high VIX futures contango nervous? I like that question. Since in the case it's thinking the VIX will rise sharply in the next months, should someone go long S&P when VIX is long and contango is low? I like that because technically I can see where you're coming from. Is a market... Oh, that's just a repeat. Technically, yes. I mean, what is it telling you when a market is steep contango, low volatility? It's like you said, it's basically saying that a lot of people are saying, I mean, the future is way more uncertain than it is right now. True, but that doesn't mean the market's right. That doesn't mean that you go long volatility and just wait it out. Eventually, the market's going to be right. No, that's not true. Because on the flip side, what could you also say? A low volatility market with VIX futures in strong contango, doesn't that also mean that the market is actually pretty, hedged enough? I mean, it's a healthy, normal market. So why would you expect a crash, right? On the one hand, you're saying the market's predicting a forward crash. On the other hand, if everything's normal and stable and calm and consistent month to month, week to week, well then, why would people outright panic? It's going to take a lot to get this market off the rails. Now, it's true when volatility is low. If something happens and the market interprets that as a significant event that's going to have some staying power, you can get some outsized crashes. That's kind of how it happens. It's a coiled spring. But the important thing to remember is it actually takes an event. It's not going to be some trivial thing that derails this market. Everybody is hedging normally. Everybody is behaving normally. The options market's normal. Everybody is right now calm. It's going to take something significant, not a one-off. It's, I'm not expecting, that's the danger of expecting market crashes during low volatility, is that it can just stay this way for months and months, years and years. I mean, how do we know? I personally, and you all know I've been talking about this a lot, at pretty much a detriment to my reputation at times, but all the mistakes that were made during the pandemic, and I spoke about them a lot, and I got a lot of hate back then, and now everybody, turns around and pretends that, oh, and I knew all along. Well, I was saying those things in 2020, and people were giving me hate mail, but all the incredible mistakes that were made during the pandemic, I happen to think that means, for me, that there's a lot of danger under this market. There's a lot of risk there because it's all surfacey. It's all, stretching statistics to make it look a certain way. But again, don't go on gut instincts. For all I know, those trillions of dollars that they spent, and I would say wasted, but let's just say spent during the pandemic, for all I know, it worked. Or at least the market's going to act like it worked for the next 5 years. How do I know in 2026 the S&P won't be at 6,000? I don't know that. I don't think it would be healthy if that happened. I think a nice big 40% crash would be appropriate at this time. But yeah, I just don't know. So I get what you're saying. I just don't make those decisions. I hate this market a whole lot more than S&P at all-time highs, let's put it that way. But I have been profiting the entire way up because I don't second guess what my strategies are designed to do. So there it is. I am somewhat nervously moving forward, acting as a robot, following my strategies, knowing that this market is weaker than it appears, and knowing that it's weaker than the government is leading on. Let's just put it that way. For someone who just joined the service, what would enter now and what would you wait for a new signal? So good question. What I would say first and foremost is don't forget, and this is a little bit of a teaser for everybody else, but don't forget there is a facts section, frequently asked questions on the website. And I'm quite sure I just joined. Do I take trades now or wait for new positions? Well, that decision will be up to your own comfort level, blah, blah, blah. Let me just give you the just know that that's there, right? That's there. And eventually I'll do videos for all of those points, but that page actually doesn't get a whole lot of views. So I've been dragging my feet on the video side of it. But essentially, you can do both, right? What this person is talking about, just to include everybody in this conversation, you know that our strategies at this point are somewhat tactical and systematic, and I've been talking about that. And we've been in this short vol for a while. The portfolio's been allocated. But if somebody joins today, what do you do, right? Do you take all of these at the same time right now today, or do you wait for the next change of direction? Now, the way that I would answer it, I have to tell you, I can't give you any personal investment advice, but both of these choices are equal on the long term. What you do in the next few weeks or month is just going to be a tiny blip on your 20-year investing horizon. So first of all, don't stress over this decision. But what you could do is just allocate. Because the way that my strategies work, as I explained, every morning I wake up, I input my data, and the spreadsheet spits out the trade, right? So essentially, even though we hold positions for sometimes months at a time without switching out, essentially everything is done on a one-day time frame. So I don't know what the trade's going to be Monday right now. But I know right now I'm in the NASDAQ, I'm short vol, and I'm in the S&P 500. I know that much. But on Monday, I have to input all my data and get the new trades. So whatever was in the email today, that is the trade for the next one day. And it is equal to everything before. My cost basis does not matter. If I've been in the QLD for 2 months and I'm up 50% on that position, like we are, it doesn't matter. Whatever happens Monday affects us both exactly the same. If the QLD is down 2%, we both lose 2%. Cost basis is just a thing that people anchor to, and it really isn't helpful to focus on that. Yes, it's true that I've been short vol for a while. We've been in the SPY, we've been in the Qs. Great. But whatever happens on Monday affects us both exactly the same. But the other choice that you brought is also valid. Maybe you just want to hang back and check out how things work. And the next time we cycle out of one and into another, the next time we move from SVXY into gold, on that day, you could jump in and take the gold position. Again, it's the same thing. Cost basis is irrelevant. Whatever happens on that first day that you take your trade affects us both exactly the same. So none of that matters. And then the last thing to just consider is they don't all switch position on the same day. So if you do the option 2, wait for the next signal, what you might find is that this one goes first and you're in gold, 25% of your portfolio, and that's it. The rest of them haven't triggered yet. And then maybe a week later, this one triggers, or 2 weeks later, this one does. You understand it's not all going to happen on the same day anyway. So for me personally, and again, this is not a recommendation, I can't tell you what to do with your money, but for me, since it's all done on single day timeframes, somebody could take the money that is available for my strategies, and you would never go all in on anybody you found on the internet. I mean, I'm a very honest person. I'm transparent. I've been here for 15 years posting results. Nobody does what I do. Nobody sits in front of a camera in front of a live audience with no moderators and nothing like that, and just answers open questions that runs a subscription service. Nobody does this. But you still met me on the internet. So don't put all your money on day one, obviously, but whatever amount you are comfortable with, it's all kind of the same. Whatever happens Monday happens to both of us. So in that respect, you can see what, in general, what I say I would do. I can't tell you what you should do, but I think there's enough in that answer to let you make a decision. Okay, I'm Canadian. It would be better if I changed my account to the USD currency for trading the VTS system. Would it be better if you traded? changed everything to USD currency. I can only tell you what I do. Yes, I did that 18 years ago. All my money is converted to US dollars, no matter what country, and I've lived in multiple countries. Whatever it is, I go ahead and convert everything to US dollars. Now, true, there are times when you think, wow, that was a great decision. And there are going to be times that, you got it wrong. The currency exchange, and it just didn't work out in your favor. But the way I see it is, number one, I do have confidence. I always have had confidence in the US and the US dollar. I think it's going to be strong-ish, for the extended period, right? I thought that in the past, and I was right, and it's doing still pretty decent, and I think the future is still okay for that currency. But that's it. There have been times when it might not have worked out for me. But what it does do is it removes one variable from the equation. I don't have to track currencies as well. This is not a specialty of mine. I'm not a Forex person. I'm not a person who's monitoring macro events, trying to calculate which currencies are going to outperform the others. This is just removing one variable. I just convert to US dollars. Everything I do is in US dollars, and that's the way that I've always done it. I can't tell you should do that, but I am Canadian, and I do that. So there's precedent for one person doing it. This is interesting. I think I missed that one. Can you go over why defensive rotation did relatively poorly compared to itself in 2022? My answer to this is definitely going to sound self-serving. It's going to sound like excuses. This is one of the reasons why I sometimes I hesitate to even talk about this, because it sounds bad, but just give me a little bit of rope here to hang myself with. I understand that when you see something that's down 38.87% for the year, I understand that that's going to sound like that's a really bad year. And it is, right? I'm not this is going to sound bad. I'm not trying to sugarcoat this. I'm not trying to make an excuse. Like I said, I've always tried to be a straight shooter. I don't brag. I don't post on the internet when I do well. You can go through my Twitter account. You will never see me bragging about performance, even though I feel like I'm outperforming 99.9% of asset managers in the last 15 years. I don't post that. I don't brag about, I'm crushing it this month. Come join quick. You can get a discount. Hurry up. You're going to miss the boat. I don't do that stuff. And I also don't make excuses when we do poorly. I talk about it directly. So with that in place, and this is going to sound bad, but I personally don't find that drawdown to be out of character for that strategy. And the reason I would say that is the components of that strategy are only 3 components. It is only, let me see if I can actually, just close some windows. You're probably going to be staring at me looking all confused here, but let me see if I can open something. I'm looking for something that says regular usage. Okay, off to a good start. Let's open that one. Okay, sorry about that. Let me do screen share. Where are you? Okay, I messed all that up, but let's do a screen share. So what we are essentially looking at is a strategy that really only has 3 components plus a cache. All right, this is all we have to work with. This is it. The entire strategy is based on this. Now, this picture is not updated for the last 7 months, so you add a couple percent here and there. But I think there's a typo here. I think that's a typo. I don't know. One of these is a typo. But anyway, we only have these components to work with. So, as I've said in the past, you can't turn garbage into gold. And what has essentially happened in 2022 is the QLD itself was down huge. It was down, I don't even know the number, but something in the 60s, maybe even up to 70%. That was down huge. Utilities got crushed that year. It was a very difficult year for all asset classes in 2022. Bonds have been getting crushed for years, right? It's in a 50%, 20-year treasuries are in a 50% drawdown right now, currently right now, over the last 3 years. So given this, The only way that I can navigate a terrible year where this one is down like 70% at one point, this one is down a lot, this one is getting crushed, and I only have cash to work with, the only thing I have to work with is the timing of the signals. And so the fact that, and again, this is the part that I don't even like talking about this because I know how this sounds when I say it out loud, but being down 38.87% for the year, and it was down 40, a little bit more than 40 at one point during that year, it's not actually that bad. Really, in the grand scheme of things, it's not actually that bad. I'm probably going to even stop talking about this because it does, I can hear myself say it. But yeah, like everything is relative. So if you were trading the S&P 500 in 2023 and you had a negative year, there's something wrong with you, like with the strategy, right? Because stocks were up, and if you're trading stocks, you should have also done reasonably well. Maybe not as good as stocks because it's hard to beat the market when it's doing well, but some positive return. But if you were trading bonds and you were down 5% last year, that's good, right? A losing year in bonds last year was probably good because bonds got destroyed last year. So if you got destroyed less, relatively speaking, that's actually pretty good, even though it's negative. And if you were up 5% in your stock market trading, even though that's positive, it's not a very good year, is it? So I'm trying to dance around the subject of essentially the 2 times QLD got absolutely obliterated. And our strategy didn't. We were actually containing the damage to only 40%, because you got to remember too that everything on this is a good chart as well, charts and pictures. Every tick downward that you suffer in a drawdown is a long distance away from breaking even. So the difference between the QLD being down, let's say 65%, and needing a 200% subsequent rate of return just to get back to break even, that is miles away from actually breaking even. And that's why it took the NASDAQ index so long. It took the QLD only broke even right there. It only recovered, there it is, maximum drawdown 65%. It only broke even to a new all-time high on June 13th. That happened like a month ago. That's the QLD. And that's the instrument that we're trading within our strategy. But for us, again, I'm not trying to brag here, but we are way above all-time highs, right? When we cleared that, that's the wrong one. We cleared that a while ago, and we are, really approaching triple digits before double digits of breaking even. So I guess what I'm saying in a roundabout way, and probably fumbling around and sounding like an idiot, because I don't like to sound like I'm making excuses, but a strategy that's made 33% a year, that had a drawdown of 40% when the underlying instrument was down 65, kind of a win. I don't know. It depends how depends how much leeway you want to give me when I'm making this explanation. If you feel like saying, hey, he's just making excuses, I'm fine with that because I can hear it in my head when it's coming out. But hopefully that sounded okay. The point is, relative performance based on the underlying benchmark is really what you're looking at. This is a side tangent, but this is another reason why I don't like when people will come in and tell me that my performance has underperformed the S&P 500. It's not that it's not true, it's just that it's not accurate. And that's how I would always say it. That's not an accurate measure. I don't know why you're doing that, because my benchmark isn't the S&P 500. I've destroyed the S&P 500. For 18 years, I've destroyed it. Now, it's true that 2 years ago, I had a losing year. So if you add 2 years before and 2 years after, it's going to look like that was a bad period of performance. But that's math. That's how all math works. If you have a strategy that has a 20% rate of return, and it makes 21, 21, 21, 21, 21 for 9 straight years, and then it has a down 20, yeah, you can add several years on both sides of that, and it's going to look like it's an underperforming strategy. But that's not accurate. That's not how we measure investment performance. That's just silly cherry picking, right? So make sure you're comparing against the right benchmark, and then sure, I'll take all criticisms you have. If this underperforms the S&P 500, If I was somehow getting crushed by the S&P in my good strategies, that is an accurate assessment of underperforming strategies. But these are negative correlation. Obviously, in a good year of the stock market, these are not going to be terribly impressive. I think that's pretty clear. So the defensive, what's the best benchmark? Not bonds, surely not bonds, not Bitcoin. Well, actually, maybe. I don't know why I said that. Actually, maybe. 2 times NASDAQ compared to Bitcoin, I'd go 3 times NASDAQ. I'd compare the TQQQ to Bitcoin, but not real estate, not emerging markets. I think you get the point, is that you got to make sure that relative means relative to apples and apples. And yeah, down 40% in 1 year sounds horrible. It's like, sounds like a complete failure until you realize, actually that's about 150% better than the underlying benchmark, which is actually kind of a win. This is why, I can hack on Cathie Wood's, just with total freedom at this point, because actually let's go check on, I haven't done this in a while, but let's go check on the old ARK Innovation ETF. Let's see where all this innovation is. This is why. It's not because it was down 75. The underlying components that she's using are super high risk. And in 2022, high risk assets crashed. So it's not that there was a big outsized drawdown. That's not why I'm criticizing. I'm saying it was outsized drawdown compared to the alternative. Compared to what you would pit a benchmark, you would say that the benchmark for ARK, it has to be the NASDAQ, doesn't it? Look at her holdings. Look at her companies. It has to be the NASDAQ. Okay, let's do the NASDAQ. Does that look like the ARK Innovation ETF? No, this does. I can't criticize Cathie Wood's drawdown because the QLD was down 65%. I think the TQQ was down almost 82% the TQQ. But it's break even. Actually, that's interesting. It's really damn near break even right now. But I can now comfortably say this is gross. Like, to just still be in a massive drawdown when essentially your own benchmark is break even, that is unforgivable. And so defensive rotation compared to its own benchmark is crushing it. Excuse over. That sounded awful. I'm not going to clip that up and put it on the internet, but hopefully I answered your specific question. Or maybe I will. Maybe I'll try to embarrass myself sometimes. I can't always put the good clips on the clips channel, right? I got to put some things that'll make people say I'm a fraud and a scammer and a liar. That drums up hate, that lights the comment section on fire, and that actually makes you more popular. The more times you can piss people off, the more popular you will be, and the more money you can make when you monetize that hate. There's a tip for all you internet people who are trying to make money online. Don't be like me. Don't be rational, level-headed, and honest. Take a page out of Andrew Tate's book. If you want to drive a Bugatti, you gotta Andrew Tate it up a little bit, if you know what I mean. It's actually pretty clever, but maybe I'll put that whole clip on the channel. I don't know. How exactly do you calculate the roll yield for your strategies? It appears you use a dynamic M1, M2 combination in relation to spot VIX instead of the raw M1 spot to VIX. Yes, I do. Because while I would say that M1 to VIX is way better than just using the straight up contango M1 to M2, if you go on VIX Central, M1, M2 VIX futures, this is what a lot of people are looking at, right? I think I have an ad blocker. It might, oh, there we go. A lot of people are just looking at the contango level. But that doesn't really mean much because the days of expiration matter so much. And I don't have to tell you this, you already know this. But if you do M1 to VIX, now you're kind of halfway to the real metric. That's far better than just using M1 to M2. But if you really want to get to the heart of it, because the volatility ETPs right now, they actually hold what? They hold over 80% of M2 right now. So is M1 to VIX really measuring the true movement? Not really, right? It's mostly holding this one at this point. But M1 to VIX is better, and all you have to do is extrapolate that one step further and use a combination of M1 and M2 to the days to expiration. So M1 to M2, based on the number of days, 100% minus the number of days. That's why in your spreadsheet download, and I only showed M1, M2 just to be very basic at this point, but perhaps I can add that calculation later. But this is why I include this very important column, the futures roll percent per day, because on this day, the entire thing is on that future. But on this day, if you see a 1 or a 0, almost none of it is. So very, very different. You have to take 100% minus the roll and factor that in to the equation. So if this is a way of just asking me to show that calculation, maybe I'll just go ahead and add that to the spreadsheet next update. We will see. What time is it? I feel like I'm way over. Hour 25. Let me just scroll through and see how many of these are real questions. My sister says, hi, hello. This is a yes to somebody. Is this still live? I think so, but I've seen some technical weird things where I'm getting pop-up messages. I think so. Do you believe in free will? No, but I'll explain why in a few minutes. Okay, did that one. Could you explain what happened yesterday when FANG plus stocks fell badly 3%, but Russell is raised 3% without volatility rising? Somebody huge doing rebalancing. So yeah, I noticed that too, and it was stark. I mean, the Russell looks crazy on I think this is a 3-month chart. Look at that. This is the Russell 2000, so this is a small cap index. Look at that. And then here's the S&P 500. Nothing happened. And in fact, yesterday it was down, like you're saying. So the IWM just rocketed yesterday. So what I would say overall is I am not a person who tracks the differences between indexes and puts a lot of stock. I know I've seen people online saying that because the Russell 2000 has just underperformed the broad market for so long, it's been years, right? Underperforming. This says something about the market. This must mean that the market is terrible and weak. And if small caps are doing badly, look out below. I'm not a person who does that. Why can't the market be largely led by the largest companies? Why couldn't that be the case? We might be entering a time when for the next 10 or 20 years, all the action's going to be in 10 stocks. Well, we have to be ready for that environment. We can't say that, no, if small caps decouple too far from large caps, this means sell everything because the world's going to end. It probably does. And I've seen people literally talking about that the bottom is going to fall out any day now because the Russell 2000 is doing so poorly. I would say, just like you said, it was some large fund flow rebalancing of some kind. Over a 1 or 2 day period, I don't think it means a thing other than, that's interesting. That was pretty extreme. I don't think it means anything beyond that. If you start to see something happen over the next several months, then yeah, that would probably mean something. But things decouple all the time. I'm not belittling your comment, but you get people talk about that too. Sometimes there's just a massive standout disconnect between performance of the S&P 500 versus, say, the UVXY. Maybe the S&P 500 goes up 0.5% and the UVXY spikes 10%, right? It can happen where there's this massive disconnect. They're not the same thing. These are different people in different markets, right? The S&P 500 is what it is. The UVXY trades based on VIX futures. It is what it is. These are totally disconnected. Now they rhyme and there's correlation, but there's been some dislocations that you think, wow, something crazy's happening, and nothing happens. So I would say don't read too much into that. Thanks for the update. I think this is the last one. And so if you don't care about my opinions on free will, this is something that I've changed my opinion on in the last, say, 5 or 10 years. But do you believe in free will? And if so, what characteristic do you think made you a successful trader? This is such a deep rabbit hole, and it's so easy for people to misunderstand. But I don't technically believe in free will because I don't believe that I'm personally responsible for making decisions. I believe that decisions happen on the level of the brain, and I, whatever I call me, I'm just the first person to notice the decisions that my brain is making. So if I go, go to sushi, for example, and there's one of those things that all the sushis are going around, and I reach for the salmon sushi, it wasn't me that decided that I was going to eat salmon, like me and the conscious self. It was my brain as a supercomputer crunching all the permutations of my life that led my brain to the decision to grab the plate of sushi. And I'm just the first person who noticed, oh, look at that. My brain wants sushi, wants salmon. So you take the salmon, right? But it wasn't really free will. Now, on the other hand, and this is why it's dangerously close to people saying, yeah, but that's you too. That's your brain. I know, but I didn't build my brain. I didn't construct it. I was just born with it. And through all of these influences, as I've carried myself through my life, it's led me to decisions that's just what I was going to decide. Like the old question of, you can ask people, think of a city, right? First city that pops into your head. All right. When I said that in my head, first city that popped into my head was Paris. It wasn't Calcutta. Why? Why was it Paris? Well, because I was in Paris a week ago. Well, I was in Paris 2 days ago. That's why my brain chose Paris. Jakarta wasn't on my, it was not possible. I mean, technically speaking, you could say, yeah, he could have chosen Cairo. Well, not really, right? I mean, my brain is going to choose what's available in the selection process. You could say, oh yeah, there's thousands of cities. You could have said anything. I couldn't have said anything, could I? My brain made a decision, and I'm just the first person that noticed, oh wow, look at that, Paris. So if that makes me a believer in free will, because I own my brain, then I guess I believe in free will. But I don't actually believe that the decisions I'm making moment to moment, day to day, are me putting a checklist down and selecting, very nuanced selection process. It's just, of course I was going to choose between these things that my brain is just readily picking for me at any time. So now the second layer to your question gets a little bit harder, because how do let's say I believe that, which I do. I believe that my brain, disconnected from my own consciousness, is making decisions behind the scenes. And, I'm just the first person narrator that's like reading the book and saying, I choose this. Not really me. But then, is there a point in any of this? Like when I say I work hard and hard work is good and you should go to the gym, and are these decisions, or is this just my brain picking, and this is just me narrating and seeing that, oh, that person, being my brain, chose something for me and I noticed it? I don't know once you get past the first step. I just believe that there is a hard line disconnect between my conscious self and my brain. I don't know what camp that puts me in, but to say it's free will is a real stretch, because it's not really, is it? Like I said, with the cities, I didn't really have the choice of all the cities. If I'm picking my favorite flavor of ice cream, I didn't really have a choice to choose black licorice. I've never eaten black licorice in my life. I mean, technically it's a flavor of ice cream, but there is a 0% chance my brain would have chosen black licorice, right? So is that free will that I could have technically done it? I don't think so. Obviously, I was going to choose something that I always choose, that my life has led me in a direction that it knows that this is what I'm going to do. I don't know. It's a very interesting thing. I think about it sometimes. How do you influence your brain to make better decisions? And is that free will, or is that not free will? Is there any point in any of this? Or should we just bump around and see what happens? Or am I literally choosing everything? I don't know. These are all deep questions, far beyond my pay grade. I'm just a geeky options guy. I don't know. But did I choose? I don't think it was me. I think it was my brain. I happen to be slightly ahead of you in the process of brain, me, the public. But I don't think it was me. My brain's just going to do what it's going to do. So free will, who knows? All right. we'll wrap it up there. If you didn't like that answer, that's why we don't talk about off-topic things very often. But remember, I am a person in this world, and if you want to just hang out and chat, I do have other interests. And if you want to get me going on these tangents about free will or about why John Jones is the greatest fighter of all time and, all these things, go ahead and ask me off topic, but we'll call it there. Thank you very much. I know it's been a while, 5 weeks, but like I said, there's going to be a pretty good content stream coming. So hopefully you all enjoy it and give me feedback. I'd very much like to, guide everything towards what the audience is looking to see. All right. Thank you.